today. Now we are touching on a very interesting, very sensitive area known as the Independent Auditors Report. And this is found in chapter 30 of your study hub. Please know this is not a teaching video, but just a video to really help us appreciate and understand better this area. Now, one of the things that you will really appreciate about this particular area is the fact that everything that we are doing, everything that we are gathering culminates to this. Right? So we start all the way from the very beginning where we are dealing with corporate governance or professional ethics. We try to do preconditions of an audit. We are planning for the audit. We come up with our strategy, with our plan, and you realize that trickles all the way to risk assessment, and then we perform internal controls. We have the determination of materiality somewhere. We delve into the dealings of collecting that evidence through analytical procedures and tests of detail, or rather just substantive procedures as a whole. And we then come all the way to writing all these findings of ours down and expressing our opinion down in our report. So this is such an important area. It just ties down to everything that we've been doing previously, or every part of the syllabus culminates to coming up with this report, expressing our opinion in that report, presenting this report to the shareholders at the AGM. And this will really guide them on the decision that they need to make concerning the business. Now, my name is Roger Gitongo, and I am an audit and assurance expert tutor. Now, let's start off with this beautiful picture. Why is this here really? So let me first of all give you a few facts. 99.8% chance. There are 99.8% chance of this area being tested in your exam as either a 4 or 5 mark question in section B, but it can also come in section A, all right? It's also a common question in section A. So I'm here basically to guide you like that lighthouse through the murky waters, the stormy seas. I'm here to just basically guide you through this, all right? Now, I want us to start off with just us delving deeper into this. First and foremost, let's try to understand the content elements of the report, what we normally find or pertain finding it. Now, this is a common section A question, by the way. Sometimes you could be told to just match the content elements in order, right? So we have the title, and the title is basically you saying that this is your independent auditor's report. We have the addressee. Who are you addressing? That's the shareholders. We have the audit opinion. This is where you identify the entity. You state the financial statements have been audited. You identify each particular financial statement that you've audited. You refer to the notes, including the significant accounting policies. You specify the date or the period covered by each financial statement. You identify the framework that was used, for instance, IFRS, and you refer to it being present fairly in all material respects in accordance with IFRS, for instance. And then we need to give a basis for our opinion, okay? So we first and foremost have our title. It's like a book. Have a title, then state who you're addressing it to, and then the main, the primary goal or the primary aim of this report is to form your opinion. So you have your opinion next, then you give us a basis. And the basis for the opinion basically just states that the audit was conducted in accordance with ACCA's. It refers to the section describing the auditor's responsibilities under ACCA's. It states that the auditors are independent, they meet the IASBA code. It states whether sufficient and appropriate audit evidence has been obtained to provide a basis for the audit opinion. Then in some cases where applicable, we might have then the going concern, and this normally comes about usually under ISA 570, and in chapter 31 in your study hub you can delve a bit deeper into when this normally features or why it features. But this is when you have some material uncertainty concerning the going concern of that business, and they've adequately disclosed that going concern issue, and you're able to use this particular section to refer to that note that they disclosed their going concern issue. Then we have the key audit matters. This describes key audit matters in accordance with ISA 701. We're going to deal with this later. And then we have other information, and other information could be the auditor basically they don't express an opinion about this, but they might necessarily comment on the its I don't say the integrity, but the reliability of the information that has been presented by the management and the chairman. So normally this touches more on the chairman's statement, for instance, a sustainability report, the CEO's statement, such things. They're not necessarily going to influence the opinion of the auditor, but they do touch on the reliability. Is this something that the shareholders can rely on? And then we have responsibilities of management. We also touch a bit on that. We just detail what their responsibilities were, like preparing the financial statements, the internal controls, things like that. And then we touch now on the auditor's responsibility. And I find this to be the greatest part. I find it to be it's like a long list, because most people don't really know what the auditor is responsible for, and therefore it's so important to just educate people, even the shareholders, so that no one ever gets it wrong or twisted and say, you guys didn't do this. And the auditors are like, but that's not what we're meant to come to do. That's not our job. That's not our responsibility, right? So it's so important to just detail that down. And then we have the name of the engagement partner listed here, the auditor's address also stated, and their signature. And sometimes this signature could be of the auditor themselves, or in some cases I've seen also the audit firm, right? And sometimes even the location in the jurisdiction where the auditor practices, and things like that. Then the date of the auditor's report, which should not be earlier than the date of the audit completion or the signing of the financial statements. Right. Now let's talk about key audit matters. This is the sign you've been looking for. Now, why did I put that picture there, or that image there? You see, the key audit matters are those matters in the auditor's professional judgment. And this is important, the auditor's professional judgment, which the auditor considers to be the most significant in the audit of the financial statements of the current period. And they are selected normally from matters communicated to those charged with governance. So you normally, it's like a funnel, you have all those things that require significant attention, and then all those matters that you communicated to those charged with governance. So you just choose the most significant. That's what forms as your key audit matter. Please know this is normally a requirement for listed companies to have, or rather, when the auditor is auditing a listed company, they should have a key audit matters within their report. Please also note it's not a separate opinion on individual matters. Then I'd also want to touch a bit on the emphasis of matter. This must include a clear reference to the matter being emphasized, and where relevant, disclosures that describe the matter in sufficient detail can be found in the financial statements. There's a lot of English here. So an emphasis of matter, a good example of this is, let's say something major has happened, a major catastrophe, like for instance COVID. This was an emphasis of matter. It's just important to appreciate that COVID had some, maybe for instance, significant effect on the going concern of multiple businesses, and therefore, actually it's not let me not talk about going concern, because going concern has its own section, but COVID had its own significant effect also on the sales of a lot of businesses, and therefore this is one of those emphases of matter that you want to just bring to the attention of the shareholders. It affects the financial statements. It doesn't affect your opinion, but it is important to bring that emphasis to the shareholders, for them to see, for them to know, for them to appreciate that this does have some significant effect on their judgment. And then there's other matter paragraph, which must clarify that other matter is not required to be presented and disclosed in the financial statements. So this is basically, for instance, sometimes the auditor might comment on the auditable parts of the director's remuneration report. This does not form the financial statements, but it's something that the auditor might still want to comment on, maybe in accordance to the legislation of that particular country that they're auditing in. All right. And then there's the key points. Let me just pick out a few things. Emphasis of matter refer to a matter presented in the financial statements, okay? But the other matter paragraph concerns matters that are not presented or disclosed in the financial statements. For instance, I've given the example there of the director's remuneration report. That doesn't form any part of the financial statements, nor is it disclosed, and therefore you do appreciate the fact that sometimes they might comment on it, but it doesn't necessarily affect the auditor's opinion, and I thought that was also important for me to bring out. Now, I just want us to look at a few things here very quickly. This is the unmodified report, but with the modified report, we can give two types of opinion. Now, the word unmodified report basically means that the financial statements do reflect a true and fair view. Your opinion doesn't really change. There's no also addition to your report. You know, the word modify means changing the structure of the report. So you could change the report and you could change the opinion, or you could only change the report but not change the opinion. So, for instance, in the modified report, that basically means there's been an addition. So you find in the very first slide that I showed you, in one of the first slides that I showed you, we had the content elements, right? We didn't see the emphasis of matter there. We didn't see the other matter paragraphs there, but they could be included normally depending on the situation, but they won't affect the opinion. So you realize here, the opinion will remain unmodified, which basically means unqualified, which basically means that the financial statements still reflect a true and fair view. But you're finding here that there's been an addition to the report, but no change to the opinion. It's like, for instance, adding, let's say, for instance, you've written a book on your life. The story is the same. So you realize that the original book had 10 chapters, for instance. And now you've added an extra chapter. But the extra chapter doesn't change the opinion of your life story. It just continues. It just gives more information about that opinion. So your opinion doesn't change of the book. What changes is the bulk, the addition to the book. So the book becomes one chapter larger, right? Or one chapter more. It's the same thing here. The report could be added, there could be additional paragraphs to the report, but there's no change to the opinion. All right? So other information, other matters, emphasis of matter, all these four don't change the opinion. They could add on to the report, they could increase the report size, but it won't change the opinion. Now we have the modified opinion, and I thought I should emphasize on that so that you can get it. Now the modified opinion, there are two cases when you might change your opinion. One is when the financial statements are materially misstated, and that's when you find here that your financial statements, let's say, are materially misstated, and the material misstatement is not pervasive, and I'll explain what pervasive means. So if it's material and not pervasive, you give a qualified opinion, okay, which appreciates the fact that there is a material issue, but it is not pervasive, and I'll explain what pervasive means. And then there's material and pervasive, and that leads to an adverse opinion. Then there's a second case where we might give a modified opinion, and that's when you find you as the auditor is not able to obtain sufficient appropriate audit evidence. Now maybe you're not able to obtain sufficient appropriate audit evidence of an area that is material but not pervasive. So you'll still give a qualified opinion. But if it's of an area that is material and pervasive, we have to give a disclaimer of opinion, which basically means, hey, listen, we can't express any opinion because we don't have information. And then we're not able to obtain information of an area that is material and pervasive. What does this pervasive really mean? Well, pervasive in audit language basically means its effects on the financial statements, which in the auditor's judgment are not confined to specific elements, accounts, or items of the financial statement. If so confined, they represent or could represent a substantial proportion of the financial statements, or in relation to disclosures are fundamental to users' understanding of the financial statements. And you're like, wait, what are you trying to say? And I'm sorry for disconnecting you here. Let me bring you back. Just to simplify, pervasive basically means it's widespread. It has a big impact on the financial statements or the controls, in simple terms, meaning it's found everywhere. Okay, it's found everywhere. It's just spread everywhere. It's like a virus. It's just everywhere. You get. It's not confined to one particular area. It's spread everywhere. Okay. Now, let's deal with a question here as we end. I have a question here on Palm Industries, and the question basically states, discuss the issue, including an assessment of whether it is material, recommend one procedure the audit team should undertake to try and resolve the issue, and describe the impact on the auditor's report if the issue remains unresolved. So I want us to look at this part. We have Palm's year end. The draft financial statements show revenue of 28.2 million, receivables of 5.6 million, profit before tax of 4.8 million. So they give us figures here. They tell us that a customer of Palm owed an amount of 350,000 at the year end. Testing of receivables in April highlighted that no amounts had been paid to Palm from this customer as they were disputing the quality of the certain goods received from Palm. The finance director is confident the issue will be resolved and no allowance for the receivables was made with regards to this balance. So told to discuss the issue, include whether it's material, recommend one procedure the audit team should undertake to try and resolve the issue, and describe its impact on your report if the issue remains unresolved. So let's look at it breaking down. Discussion of the issue, 1 mark. So how could I discuss this? Talk about it, try and see what's the problem. So here the customer has not paid the amount, and this, what's its effect? So post the end cash receipts testing has been done. It has been confirmed that no payment has been received from the customer as they're disputing the quality of goods. No allowance has been made for this, and therefore there could be a possibility of receivables being overstated as the receivables amount may not be paid. You see what you're doing here is you've discussed the issue from the scenario, right? But at the same time, you're explaining what effect it might have. The effect is that it could be overstated. The receivables could be overstated. But you're also discussing the issue. What's the problem? Secondly, calculate materiality. So the amount was 350,000. We look at it, we compete, or rather not compete, but we compute against revenue, we compute against receivables, we compute against profit before tax. And we see here that this is material because they're all above the profit threshold, the material threshold. And if you want to get the thresholds, go to the materiality chapter, I think under chapter 10 or 11 in the study hub. This will really help you to really understand better those thresholds and what could be considered material. Okay, like in this case, these are very material figures normally. Against the benchmark given. And then the procedure. So this is a procedure that we could test in accordance to the question. Review and inspect the correspondence, the communication between Palm and the customer, just to really assess the likelihood of receiving payment from the customer. Fantastic procedure, right? We review, we inspect that correspondence just to try and assess, is there a possibility of them paying? And then the last one, the impact, 2 marks. So what was the problem here? First and foremost, if the management does not create the allowance for receivables, then the auditor will have to look at this, modify what? Not their report, but their opinion. And also their report, because the issue is material, as we've stated, and the receivables will be overstated. So the first thing that happens here is the modification. Specify, that's the first impact to the report. There's going to be a modification of that opinion. All right, and we appreciate the fact that this is just on the receivables area, so it's not pervasive, it's not spread out. Most of our students overthink it and say receivables could affect sales, sales could affect profit, and we can trickle down to all that. The idea is that which account primarily is affected. It's just receivables, allowance for receivables. So the thing is that it's not spread out everywhere. It doesn't affect going concern per se, right? It's not a spread out thing. It's not everywhere. So we won't give, because the issue here is a material misstatement. It's not that we've not been, as auditors, it's not that we've not been able to obtain evidence. It's just that this is a material misstatement we've detected. And at the same time, this material misstatement is material, 1, and 2, it's not pervasive, so we give a qualified opinion. And then we'll use the except for wording. The except for wording appreciates the fact that everything, the financial statements do reflect a true and fair view, except for this receivables figure. You get? So it's because you're appreciating that everything might be fine apart from this area, because it's not pervasive, it's not spread out. It's just that area that we have an issue with. So except for. Now, we will also follow the basis for qualified opinion will be included so that we can explain the material misstatement of the receivables and its effect to the financial statements. This is a fantastic answer. You've spoken about modifying the opinion. You've given the type of opinion that you're going to give. And then we appreciate that because now the opinion is qualified, it has to be followed with a basis for qualified opinion. If you remember the content elements, there was title, addressee, opinion, and then basis for opinion. Now here we give a basis for qualified opinion. Okay, that's where it comes from. Fantastic way to answer. And if you follow this structure, I guarantee you 4 or 5 marks. 4 or 5 marks based on the question. All right? Fantastic. And as we come to the end, I hope you can now see the light at the end of the tunnel. I hope this was much clearer, and I do hope that you understood it well. Thank you so much for watching.